This is Module 2, Learning Objective 1. And in Module 2, we're going to look at the financial statements. And we're going to look at how financial statements are prepared. If you're an accounting major, this is all going to be review. If you're not an accounting major, it's also going to be review. But you probably want to go through this carefully to help you out in order to be ready for the remaining modules. So this is very highly recommended for anyone who doesn't feel like they have a strong background in accounting. If you're a CPA, then you could probably teach this instead of me and do a better job. So we have the balance sheet, and the balance sheet, as I said before, has three sections: assets, liabilities, and stockholders' equity, and it's all as of a certain point in time. Usually December 31st. If the company has a different fiscal year, then it would be whenever the fiscal year begins and ends, but it's going to be December 31st at the stroke of midnight. Balance sheet accounts are called permanent accounts because these accounts carry over. In order to change them, to increase them, you have to put more money in. To decrease them, you take money out. A good example of it is cash, right? If you deposit cash, your cash balance goes up. If you take cash out, the balance goes down. You'll see, it sounds obvious, but you'll see when we go into temporary accounts why that's not always the case for all accounts. So costs flow from one balance sheet to another. And we have what we call expenses. Expenses provide you with an immediate benefit. That's why they're called expenses, because we spent money on something and we got the benefit from it. If we didn't get a benefit from it, we wouldn't spend the money, right? So people usually don't think of expenses as benefits. They think of expenses as costs. They are costs, but they provide you with a benefit. Otherwise, you wouldn't spend money on them. Now, the benefit is immediate. You would record it as an expense when you get the benefit. Sometimes when you spend money on something, you get the benefit in the future. And that would be called an asset. So if you spend money on something and get the benefit now, it's an expense. If you're going to get the benefit in the future, then it's going to be what's called an asset. My chair here is not so comfortable. If you invest in an asset, then when the asset gets used up, then it becomes an expense. For example, let's say you pay for advertising next month. That's an asset because now I'm entitled to this advertising. Once the advertising runs, then the costs have been used up and it becomes an expense. So an asset is something that gives you a future benefit. You've spent money on something and now you're entitled to some kind of benefit, and that benefit should bring you future profits. Sometimes it could reduce your expenses, but usually it's something that brings you future profits and sales and profits. And the other quality of an asset is that you have to actually own it or control it in some way. Almost all the time we're talking about ownership. And so assets have these two qualities. Here's an example of an asset speaking of all companies, Apple. We've talked about Apple before, and this is our feature company for this chapter. And here you can see the list of assets, and you can see why all these have future benefits. Cash and cash equivalents, marketable securities. Cash obviously has a benefit to it. Marketable securities are stocks that a company owns that it could sell. There's a future benefit. You could sell them. Accounts receivable is your customer owes you money. So when your customer pays you, you get a benefit. Inventory are items that you're holding that you're going to sell. Again, they provide a future benefit because you're going to be able to sell them. Property, plant, and equipment, we'll talk into what that is. And long-term assets. And these all add together up to long-term assets. Let's talk specifically about what these items are. Cash is currency bank deposits. And a lot of companies, because cash, currency itself and bank deposits usually don't carry very much interest. So what FASB did is they added something called cash equivalents. What a lot of companies do is they invest their cash into highly liquid securities, such as money market funds or government treasury bills. And these securities have a maturity of 90 days or less. These are also considered to be cash. So it's not something that everybody is aware of, but if you invest in treasury bills with less than 90 days, on your balance sheet, those would actually be listed as cash, because they're as good as cash. Short-term investments are investments that you plan to sell in the short run. What we mean by short run here is a year. Now, what if you don't sell it in a year? If you intended to sell it in a year, that's good enough. Accounts receivable is money that's owed to you by your customers. And by net, I mean we report accounts receivable at the amount of money we actually expect to receive, not the total amount of money that customers owe us. So customers might owe us $1 million, but we only expect to receive $900,000 because not all of our customers pay. So therefore, accounts receivable should be stated at the net amount, which is the amount we actually expect to collect. Let me just talk briefly about what net means. Gross means the total amount. Net means the gross amount minus some kind of deduction. So gross accounts receivable would be the total amount of money that customers owe us. Net accounts receivable would be the gross minus the uncollectible accounts, the portion of accounts receivable that we don't expect to collect. Inventories are goods that are purchased or produced for sale to customers, and that's just what we're going to sell our customers, Prepaid expenses are expenses that we pay for in advance. Like before, I gave you the example of paying for advertising in advance. That would be a prepaid expense, and that's also an asset because it brings us a benefit. Long-term assets provide us with a benefit in the longer term. What all these current assets had in common is that we expect to get the benefit from these within a year. Now, you might say, but if you don't sell something within a year, is it still a current asset? Most of the time, it is going to be a current asset. Or it should be a current asset. Long-term assets are things that we plan to keep for more than a year. And what happens if you keep them less than a year? It's still a long-term asset, unless you intentionally, you make a decision. Let's say you have a piece of land, and you're like, I'm going to sell the land in 6 months, and I've got a contract. It's not a long-term asset anymore. It becomes a current asset. Anyway, land, buildings, and equipment would be PP&E. And we say net because we have to subtract accumulated depreciation from this. Long-term investments are investments that you plan to sell after a year. So you say, what happens when you sell does that mean that if you have a long-term investment, you have to keep it at least a year? No. If you buy a long-term investment and you determine, I plan to hold this a year, and then after 6 months, you decide, you know what, I'm going to sell this now, it's still a long-term investment. It all depends on your intent when you make the investment. And you can move them back and forth, and we're not going to get into the accounting for all that. Intangible and other assets are assets that have no physical substance. Patents, trademarks, franchise rights, goodwill. The thing about intangible and other assets is that these are not developed in-house. If you develop an intangible asset in-house, then it's expensed when you spend the money on it. And it's just a fluke of accounting. We're going to go into more detail about it later on. These are things that you paid for. So if you buy the rights to a patent, or you buy another company that has a patent in place, and you pay more money for that company because you know it has a patent, then you can put that on your balance sheet as a patent. Goodwill we're going to get into. So most assets are recorded at historical cost, which is what you paid for them. Certain assets are recorded at market value when we can easily determine and reliably determine what the market value is. That would be marketable securities are an example that are recorded at market value. But most assets are recorded at historical cost. That is whatever you paid for them. If you don't know the value of the asset, oftentimes you cannot recognize it on your balance sheet. And a lot of assets don't go on the balance sheet. So for example, let's say that you spend years and years building up goodwill. Big deal. It doesn't matter. It doesn't go on your balance sheet. If you buy a company and you pay extra because there's goodwill, then you could put that on your balance sheet. But if you just do things that create assets naturally, intangible assets, those don't go on your balance sheet. But in general, we record assets at their cost, whatever we paid. Liabilities represent future economic sacrifices. So assets represent future benefits. Liabilities represent future sacrifices. Most commonly, it's debt. You borrow money. Some liabilities have interest, some don't. Stockholders' equity is the difference between assets minus liabilities. If you take your assets and you subtract your liabilities, then what's left is what belongs to the stockholders. Now, stockholders can build up stockholders' equity in two ways, as I've said before. One way is by buying stock from the company. So when they buy stock from the company gives them stock and they contribute capital into the company. And that would create stockholders' equity. Alternatively, if the company has profits and it doesn't distribute some of those profits as dividends, whatever it keeps in the company is going to be called retained earnings. Now there's an other category here which we're going to talk about later on, but it's not very important to get started. We've also got here you can see liabilities and stockholders' equity for Apple. And you can see liabilities are split into two sections, current and long-term. And shareholders' equity has three numbers. They have common stock and additional paid-in capital. That would be what we call contributed capital. Here's retained earnings, and there is that other category. Let's talk about current liabilities for a second. Accounts payable is money owed to your suppliers, and it'd be specifically to suppliers. So what frequently happens in companies is that when I buy something in the store, I have to pay immediately, right? When a company orders goods and the goods are shipped to the company's factory or warehouse, they'll mail a bill to headquarters, and the accountants will pay for the bill in 30 days or 60 days or whatever. That money that's owed to the suppliers is considered accounts payable. Accrued liabilities are expenses that you had but you haven't yet paid. For example, if employees have done work for you all month but you haven't yet paid for them, that would be an accrued liability because you've had the expense but you haven't yet paid for it. Unearned revenues are revenues where situations where you collected money from your customers in advance, but you haven't yet provided the service. For example, a gym membership. A gym charges you, say, $50 at the beginning of the month for membership. Then that's unearned throughout the month. A better example is if, let's say, you pay a whole year in advance. Or let's say you pay your Seton Hall tuition in July, but you don't actually start the semester until the fall. Then in July, Seton Hall is an unearned revenue because they've collected the money from you, the customer, and now they have a liability to you to provide the service. Another example of this is customer deposits. Let's say you want to buy a Porsche and you have to put down a $5,000 deposit. They'll deliver the car in 3 months. That would be an unearned revenue, a liability on the part of the Porsche dealer because they owe you basically $5,000 worth of car. Short-term notes payable are notes due within a year that you owe. And current maturities of long-term debt, the deal is like this. Let's say you owe monthly payments for the next 30 years. The next 12 monthly payments due within the next year, right? So that's going to be a current liability because it's due within a year. Everything after that is non-current. Now, a useful measure is called working capital or net working capital. And net working capital is the difference current assets, which we just went over, minus current liabilities. And working capital is a useful way to look to see how much money the company really has to play with at any given time. There's also something called the operating cycle. And this is the period of time on average between when you buy your inputs and you collect money, when you buy your inputs and actually pay for them and you collect money from your customers. So when you think about a business, right, they have the supply chain, which we talked about briefly in the last chapter, and you first buy raw materials and you pay for them. Then you put them through your factory and you convert them into finished goods. You move the finished goods into the store. The customer buys the finished goods, and then the customer pays you. So what's the period of time between when you pay for the raw materials and you actually collect the money from the customer? That's called the operating cycle. And the thing to know is that the operating cycle, and here you can see a picture of it, usually takes 3 to 6 months. But you actually have companies where it can take years and years and years for them to produce goods. For example, consider a company that makes wine, and the wine needs to age for 5 years. Then the operating cycle would be longer than 5 years because they have to grow the grapes now, but they're not going to be able to sell the bottles of wine for more than 5 years. So companies need cash to do all of this because they have to pay for the goods at a certain point in time, but they don't collect the goods from the customer until a long time in the future. So if you're a winery, right, that could take years and years and years. And so companies need cash in order to cover this gap. And that's what the cash operating cycle describes. Here you can see the cash operating cycle calculated for Apple and 3M. 3M makes Post-it notes here. Post-it notes. Apple, they make stuff. So what we would do to calculate the operating cycle is add the number of days outstanding, sales outstanding. That is how long it takes you to collect your receivables. Number of days inventory outstanding, that's how long it takes you on average to sell inventory. And number of days payable outstanding would be subtracted. That's how quickly you pay your suppliers. So you can see Apple's cash conversion cycle is weird. It's actually negative because Apple pays its suppliers long in advance. And the reason why it does this is because it has a lot of money and it can get a lower price from the suppliers by doing this. But 3M's a more normal company. And you can see that it's their cash conversion cycle for making Post-it notes is 94 days. So it takes 50 days to collect payment from their customers. That's Staples, right? It takes 85 days to move the inventory through from raw materials until they actually sell to the customers. And it takes 42 days for them to pay their payables. So it's a 94-day cycle. Between when they pay their payable and they collect the money from the customer, that's 94 days. So that would mean they need to cover that somehow. And the way that's going to be covered is through working capital. We also have what we call non-current liabilities. And this is long-term debt, usually. There's usually just one item here, long-term debt, and sometimes other long-term liabilities too for a pension liability. And this would be the portion of your debt that's due after a year. So remember that mortgage example I gave you? Every month they have to make a payment. The first 12 months are current. Everything after that is going to be non-current. All debts due more than a year. There is a little exception to this. I always bring this up. And the exception kind of goes like that. Where the exception goes where you have an operating cycle of more than a year. So to divide between current and non-current, it's usually 1 year. But certain businesses are in businesses where it takes more than a year. If so, then your operating cycle is going to be that period of time. So let's say it takes 5 years to make a bottle of wine. Then your operating cycle is going to be 5 years, and then everything within 5 years is current. Everything more than 5 years is going to be non-current. And that's a very rare exception, but I like to bring it up because I want to, give you all the details. Other long-term liabilities, besides long-term debt, the most common ones are pension liabilities and long-term tax liabilities. We're going to talk about both of these. Pension liabilities is when you offer your employees a defined benefit pension plan, which very few companies do nowadays, or if you owe taxes in the long run, which is not uncommon at all. Contributed capital, as I said, basically consists of two components. Capital consists of two components plus other. Contributed capital, retained earnings, and other. So contributed capital may have two different components, what's called common stock and additional paid-in capital. Companies often usually have something called par value. And this is really an arbitrary value that's assigned to the stock. So let's say you have $1 par value. When investors buy your stock, they don't pay par value, but they pay something extra. So let's suppose that investors pay you $10 for your stock. Then $1 would go to par value, and the other $9 would be additional paid-in capital. Again, they pay $10, so it would be split up. $1 would be considered par value, and the remaining $9 extra, that's 10 minus 1, would be considered additional paid-in capital. Preferred stock is a different class of stock. It's very unusual. But this stock usually carries a fixed dividend, and the company has to pay the fixed dividend before it can pay dividends to common stockholders. There's also something called treasury stock. This would be a situation. The treasury stock, by the way, is usually, I wouldn't call it contributed capital. I would call it other. But treasury stock would be when a company buys the stock back from its stockholders. So normally a company issues stock to the stockholders and receives money. but the company can actually buy it back from them and say, I don't want you to be a stockholder anymore. Here's your money. Give us back the stock. Retained earnings is, again, net income that was not distributed as dividends. So you'd have beginning retained earnings plus net income minus dividends equals ending retained earnings. The big area of other is called accumulated OCI. And that's the third category, is other. And what these are changes in market value that didn't make it to the income statement yet. The way I usually describe this is like a shoebox. That what will happen sometimes is, because of a fluke in accounting, you have adjustments to market value on the balance sheet, gains and losses really, but you don't have to put them on the income statement yet. So what happens is instead they go into this special category. Now, what we're talking about here is book value. We're talking about the GAAP numbers that are used in preparing financial statements. This is a number, and it's based on the tools that we just went over right here. But that's not the stock value. So you can come up with a book value, but the stock market is going to come up with a completely different value of the company, which 99% is going to be higher. And that would be the number of common shares outstanding times the stock price. And usually you could just see this. It's listed on any website. If you go to Google Finance, you could see it, or the Wall Street Journal's website. And these could be different for a wide variety of reasons. First of all, the balance sheet is based on historical cost principles, and we're very conservative about not reporting assets that we didn't actually pay for. So therefore, the balance sheet is valued in a very conservative way. Investors are not restricted by that. Investors are going to pay for the stock whatever they think the stock is worth, which is almost always more than the book value. Furthermore, GAAP excludes certain assets that can't be measured. So if your company develops goodwill internally, big deal, But when investors look at a stock, they think about that goodwill and they're willing to pay for it. GAAP is purely based on historical performance in the past, and it doesn't focus on what's going to happen in the future. Whereas investors are primarily concerned with what's going to happen in the future. And so they are willing to pay more money because they are usually optimistic and they think that things are going to be better in the future. So here they have a number that book value is usually about half of market value. And that varies very, very widely. It can be as little as a tenth of market value, believe it or not.